Well, welcome to our July State of the Markets. We are going to take a look back and see what has happened in the capital markets in both the previous quarter as well as year to date. As always, our advisory services are offered through Retirement Planning Services, LLC. Past performance does not indicate any future results. All of these indices are unmanaged and they cannot be invested into directly. So let's start off with taking a look at what has happened in the capital markets so far year to date. And so as we look at these index returns from January 1st of this year through the end of the previous quarter on June 30th, US stock market was up about 5.8% for the current year. International stocks are up about 19.5%. We'll dive into a little bit more of why international stocks have outperformed US this year. And then emerging markets are up about 15.6%. As we look on the bond side of things, the US aggregate fixed income is up about 4%. US Treasury is up right around that same amount, about 3.8%. Municipal bonds are down about 0.3%. And then global reinsurance is up almost 3%. Again, if we remember back to the first quarter state of the markets, there were the California wildfires that were a driver of a negative performance of the global reinsurance. But so far, the remainder of the year, that sleeve has done decently. So let's take a look a little bit deeper into what has happened in the prior quarter. Now, historically, we look at what happened in Q2. And if we can remember back 3 months ago, I know sometimes it's hard to remember what has happened even yesterday, but if we look back, on April 2nd was Liberation Day, where the tariffs were introduced. And if we look and see that first week of the quarter had some incredible volatility. US stocks were down a little bit over 11%, almost 12% that week. International stocks were down almost 8%. Now, if we look at the remainder of the quarter, US stocks were up 11, international stocks were up 12, emerging market was up 12. So what happened there? Well, from April 9th, where President Trump decided to defer the tariffs till the end of the quarter, there was a bounce back in US stocks of almost 26%. International stocks bounced back about 22%. So while the first week of the quarter, really the first 2 weeks, brought some incredible volatility, a massive drop over a couple of days span, the remainder of the quarter was remarkably strong across the capital markets. And we'll dive into this a little bit further. Spencer's going to talk through what happened on the currency and how that really affects what's happening in the international markets pretty strongly and what's happening with the dollar. So as we can see on the remainder of the markets, US aggregate fixed income for Q2 was up about 1.2%. US Treasury is up about 1. Municipals, again, down by 0.1%. Global reinsurance up almost 2%. If we think about another nuanced factor with the Treasury markets, is Moody's downgraded the US Treasuries or the US government debt in mid-May. They just downgraded us a little bit. So there was a price drop there of about 0.75%. And then the remainder of the quarter finished out from mid-May till the end of the year, at the end of the quarter, up about 2.6% from that point. If we dial in a little bit further, looking at US equity returns throughout the entirety of this year, US large cap has really driven that side of things versus small cap. Large caps are up about 6%, where small caps are down about 2% for the year, where large value and large growth are right on parity, up about 6% and 6.1% on either side. If we look at just Q2, we see large caps did a little bit better than small caps, up 11%, where small caps were up 8.5%, but both in that positive territory, where large value was up only about 4%, so not as strong of a Q2 performance, where large growth really did quite nicely, up about 17.8%. If we dive into the international markets, international large caps lagged behind their small cap performances for the entirety of the year, up 18.8% versus up 21.2% for small caps. If we look at large value is up about 22%, where large growth for the year up only about 15%. So really those historical tilts towards small value have really seen some outperformance through the entirety of the year for international stocks. If we look at just last quarter for international stocks, large caps lagged behind their small caps. 11.5% for large caps, up 17.1% for small caps. If we look at large value, lagged a little bit behind large growth, up about 10% for value versus 13% for growth. So Spencer, you want to dive us into what has happened with the dollar compared to both the euro and the yen?
Big picture, what's happened with the dollar is it has weakened versus the euro and the yen. And there is a sense that with the tariffs coming into effect, that there's less certainty of US trade policy. One of the things that we've benefited from for many, many years is that we are the reserve currency by and large for the world. That means that our currency is more coveted. There are more people that will trade in US dollars and hold US dollars, hold US Treasury bonds. But as we saw the tariffs go in place on April 2nd, and then kind of go back and forth with these trade deals and announcements and so on and so forth, I think the world says, okay, we're not as certain of the US fiscal policy at home, certainly in terms of budgets and bills and those kinds of things. But even more importantly, we're not sure about where the US is going in terms of working with trade partners. And that has weighed on the strength of the dollar. So you can look at this chart and you see the exchange rate over the last 6 months. It went from almost parity with the euro, 1-to-1, close to that, dropping in such a way that the euro actually appreciated 13% over the US dollar. What that basically does is international investments become more valuable in that. So, if you have a company that does its business primarily in euros or is located in the European Union and such, then they're going to have better performance than U.S. companies if all other things are held equal. So again, the big picture there, you could see the exchange rate moving downward. That is, there are more dollars required for 1 euro, basically there. And you could see in particular that it was more or less flat through 2024, kind of reached a little bit of a peak there in January, and then a steady decline there over the last 6 months of the year. If we look at the yen, the Japanese yen, not quite as pronounced a move, but a similar move in that when we started the year, about 157 yen to the dollar, and then at the end of the second quarter, 144 yen to the dollar. So the yen has appreciated almost 9% against the dollar. So same dynamic for Japanese companies when we look at their earnings and the quality of their earnings and how the stock is priced for those companies that are domiciled in Japan, about a 9% move. So again, if companies were trading at exactly the same value there in those markets, but you have an appreciation in the currency, that can be a significant driver of outperformance, which is what we've seen in the developed markets outside of the U.S. relative to their U.S. Stock counterparts. So, if U.S. stocks are up mid-single digits, 5-6%, then for the year, then we look at the international developed market stocks, and they're up another 10 to 15% above and beyond what their U.S. counterparts have done, even though that price to earnings ratio may not have changed all that much. It's been the currency that's driven this. Now, you could say, what is required for us to go back to a place where maybe the U.S. dollar regains its former strength? And I think that's going to take some time. We look at things and there's a volatility in trade agreements. There is an uncertainty in terms of the U.S.'s engagement with the world. And so it could be that we regain that level of dollar strength here over the next year or two. But I don't think this is going to happen overnight. It's not just as though, President Trump is able to get a trade deal in place with China and then everything goes back to the way that it was. There tends to be a quick movement on the downside and then time that it takes to rebuild that level of trust. And, at the end of the day, you had a lot of European investors, a lot of European institutions that sold dollars because they didn't think that the U.S. trade policy was going to be as stable. They wanted to repatriate a lot of their own investments and ended up moving back to bonds denominated in their own currencies. And Japanese investors did the same. So as we have more of a protectionist policy rather than an international open trade policy, that does weaken the dollar because we've been prime beneficiaries of the international trade situation here over the last several decades. If we look at the next slide, fixed income rates of return, as Austin alluded to, up about 4% for the year. The yield curve came down just a little bit. So as we've talked about many, many times, as interest rates drop, fixed income prices go up. But the primary driver of this is just that we have a fairly high interest rate. So if the yield curve didn't move at all, we would still have a rate of return of something like 2.5 or 3% in the aggregate fixed income market. But we did see interest rates come down a little bit there. You could see rates of return a little bit higher with Treasury inflation protected securities TIPS, because inflation expectations continue to be rather high compared to where they were at the start of the year because of the higher level of protectionist policies and tariffs and such. You can see the short treasuries and long treasuries actually have both underperformed the aggregate, which is kind of interesting, but the 10-year treasury dropped in its yield, and so that's been one of the better performers, whereas the shortest of the treasuries and the longest of the treasuries haven't seen quite that same movement in the yield curve, so have not done quite as well. You look at high yield corporate bonds, they pay a higher coupon, a higher interest rate, so they've done a little bit better, as have corporates overall. When we turn to U.S. municipals, yields have actually gone up in U.S. municipals, which has driven prices down. I think the outlook there is still strong going forward, but it has been a little bit of a drop so far this year. Austin alluded to it, but global reinsurance has had solid performance through the first half of this year, up almost 3%. Had a little bit of a dip there in January and has recovered since. When we look at the second quarter, again, nothing too much different from what we've already talked about, but overall, the yield curve didn't move much in the second quarter. A rate of return somewhere between 1 and 1.5% on most of the areas there. The one exception being that U.S. long-term treasuries were down about 2%. Like Austin said, when we had the downgrade of U.S. Treasury debt, now we have agreement among the three rating agencies that the U.S. is no longer a AAA rated institution. So investors became a little bit more concerned about 20 and 30-year Treasury bonds, if the U.S. is going to be money good on those. And so as they become more concerned, the interest rate moves up, prices move down, and we see that in that 2% drop or so. Again, high yield and corporate bonds, higher interest rate, higher rate of return there. And like we talked about, a slight drop in municipals and reinsurance performing well. So how do we respond to this? I think more than ever, we go back to the fundamentals, the basics. We seek broad diversification. We don't know what's around the corner, whether it be with stocks or bonds, whether it be with levels of profitability of companies or with yield curves for the fixed income side of things. Certainly on the alternative side of things, we don't know what natural disaster could be out there. So we want to have broad diversification. There are a lot of different ways that we're rewarded as investors, but patience is the chief one. Warren Buffett is famous for saying that the stock market is a great mechanism to take money from those who are not patient to those who are patient. Basically, taking those who cannot take that long-term perspective, taking their money and giving it to those who have a long-term perspective, because those who don't have that long-term perspective tend to make poor choices when the ups and downs happen. So we seek broad diversification because we want to have a lot of different places to withdraw money from and to be diversified as we invest over the long period of time. So that's the first principle that is even more important, I think, now. At the same time, we recognize as we do this presentation, as we do this video recording, at least in the first part of July, that the stock market is in the U.S. is near all-time highs. So not a bad time to look at a portfolio and say, okay, do I need to rebalance? Do I need to make some adjustments here? as we're at this point. We don't want to make big adjustments when the stock market is down 10, 15, 20%. We certainly didn't want to do that in the first week of April, ideally, when we saw that big drop driven by tariffs, because we don't know what might be around the corner. And that really leads to this next one. Take a deep breath amid turbulent markets. When we looked at the first part of this quarter, as Austin shared, the drop there, a double-digit drop in U.S. stocks, almost a double-digit drop in international stocks. We also had volatility in the fixed income market day to day. Those are not easy things, I think, for anyone to deal with, especially if you're glued to the financial media and reports coming out here and there, and is the end nigh because we're going to do one trade policy thing or another. None of us really had a great sense of where that was going to land. Didn't matter what side of the political aisle really that you were on. The people that we talked to looked at what was going on in the first week of April and were kind of scratching their heads. So all of that eventually panned out. So taking that deep breath amid turbulent markets, really, really critical there, and saying, is there something that I really need to do here, or did I plan for a drop like this, whether it be 10% or 20% or 30% or even more? But we come back to this focus on what we can control. The image that comes to mind so often is what Stephen Covey would talk about in his 7 Habits of Highly Effective People: the circle of concern versus the circle of control. There are a lot of things that we can be concerned about in life, and particularly in investments. We can be concerned about what's going on with tariffs, what's going on with exchange rates, what's going on with profitability, what's going on with artificial intelligence, what's going on with all kinds of different things. There are very few things that we can control in investments. I'm not going to be able to control what Jay Powell does with interest rates, and the Federal Open Market Committee decides, on interest rate policy. I'm not going to have any control over what goes on in the tariff negotiations and international trade negotiations. But what I can control is how I respond to those pieces and my perspective. And if I can keep an even keel and say, okay, well, we knew that there'd be some ups and downs in this, can come back to what do I need to do with the portfolio, if anything, in the midst of this, then that focus can be helpful. It can also save us a lot of time and a lot of emotional energy, because when we recognize that there's a very limited amount that we can control, and we should have a plan in place that can deal with those elements, why it should allow us to kind of turn the page, move on with our lives, and not watch the financial media more than we need to. So with that, I think those are the ways that we respond. Let's make sure that we have a good financial plan, we have a good diversified portfolio, that we have a good perspective, and then that we respond accordingly. As always, it's great to be able to connect with you. If you have questions, don't hesitate to reach out to us. I'm always happy to have conversations about any updates that we need to make with clients with their portfolios, or provide some perspective there. And with that, hope you have a great rest of the week, and we'll look forward to being in touch. Thanks.
If you like these financial planning videos, please share with a friend. And if you have questions, go to our website at SiriusRetirement.com. This content was provided by Retirement Planning Services. We are located in Knoxville, Tennessee. You can visit our website at SiriusRetirement.com. The information in this recording is intended for general educational and informational purposes only, and should not be construed as investment advisory, financial planning, legal, tax, or other professional advice based on your specific situation. Please consult with your professional advisor before taking any action based on its contents. Advisory services offered through Retirement Planning Services, LLC.